Hi, Henrik. Thank you very much for joining us today. How are things in Copenhagen?
Thank you for having me on. Things are great here. It's been a good start to the new year, so all is good.
I've never been to Denmark. I would love to go. It's often voted the happiest place in the world. Do you think it is?
I don't know about that. I also hear that we have one of the highest suicide rates in the world, I think. So I don't know how those two balance, but okay, but I'll take it.
That's an interesting point. And maybe we'll pick that discussion up at another time. So I
Yeah.
want to talk about the economy now. You've been very bullish on the US economy and therefore the markets. And as you know, the markets have been on a big tear all through 2023, and now we're into 2024. And I want to get your views on where you think the markets are going in 2024. But before we do that, why don't you just start with why you were so bullish on 2023? What were the indicators that you saw?
Well, I actually one of the foundation for what I do is very deep analysis of the business cycle in a very thorough way, and probably a lot different from what you see with other analysts. And that analysis simply showed me, and it keeps showing me also, that we do not have an economy. We did not have an economy going into 23, which was actually falling into a recession, even though you had all the negative outcomes of what was an inflation spike caused by an imbalance between the supply and demand, caused by massive stimulus into a supply crisis. Well, then you get an inflation spike, but the economy was not falling into a recession at that point. And actually, that was the point where the economy was overheating, which is not good. So what we saw there was a natural pullback when inflation gets too hot, but that's not what creates a recession in an economy. So my business cycle model did not at that point support any kind of real correction or real, let's call it bear market, because I know we did go down more than what we normally would call a bear market, but still what I saw was that this would be recovered rather fast, because when inflation went back down again, and the imbalances in the supply and demand would be kind of balanced out again, well, then you would also see the economy start to recover, and you would see the markets follow up based on with that. So I was very, very bullish getting into that. I honestly didn't understand where all the bears that came from, because normally when you have inflation spikes and inflation comes down again, which was really clear to me that it would, well, then you would see that the stock market would go up a lot. So that was the one side, and the other side is the technical analysis, which showed me simply that there were a lot of upside in the market, and I called already in October of last year, 6,100 on the S&P as the target, and I stand by that.
I'm sorry, what was your target on the S&P?
6,100, yeah.
And right now we're around 4,700, so that's a significant move of around 30%. So tell us how you get there. How do you get to a target of 6,500 on the S&P?
6,100, but yeah. So I this is where I use technical analysis. You cannot do that based on fundamental analysis. So what I do is, again, I look at what we have in the business cycle, and the business cycle tells me we are still in an economy that, despite being hit by, the Titanic has hit the iceberg, meaning the inflation has created the havoc in the economy by rates moving up, market yields moving up, and that is really causing a lot of havoc on the consumer side. And this will be felt later on. But for now, what is keeping the Titanic afloat is really the labor market, and it has done so until very recently. And I don't see anything that will change that for the next, let's say, 3, 4, 5, maybe 6 months. But I don't think we will get that far potentially. But the leading indicators in my business cycle tells me that we will see a recession, and we will see a very big recession, and we'll probably see a recession that is much, much worse than what we saw during the financial crisis. And I think that's also where my call is a bit controversial. So with that, I use my technical analysis, to set up the Elliott waves that I do, the Fibonacci extensions, and then the 6,100 is what comes out. it may be 6,000, it may be 6,100, but that's around the number.
And can you be a little more specific when you talk about business indicators? What indicators are you looking at to give you these targets?
Yes, so I mean, on the business cycles, side, it's I use the conference board. They publish the leading indicators, the quintessential indicators, lagging indicators, and based on that, I have a model which has been been tested, proved over the last 80 years. Every time you get a recession signal from the leading indicators there, you will get a recession. And it doesn't come set in immediately, but that's what I use. So as the leading indicators is housing permits, it's initial claims, and so on and so forth. You can simply look them up in the conference board, but it's more about how you actually use them and which kind of modeling you put upon that in terms of understanding it. But there is a very, very strong recession signal there, and that in my world and how I look at it, then before we get to that end, there are certain Fibonacci levels that needs to be reached, and in order to get there, then 6,100 comes out. It's a little difficult to explain how I do the technical analysis without having a chart in front of me, but it's sort of what I do there.
And what's your timeline associated with this target on the S&P of 6,100?
Well, I think it's going to be really, really quick, because my recession signal, or my expectation of when the recession is going to set in is somewhere around the mid of next year. No, sorry, this year now. This year, I've been saying so many times the next year in interviews, but this year, 24, we'll see a recession probably setting in around June. That's what I see now, and then I think we got until a month or two before that for the markets to rally. So I think what we're going to see here is a very, very steep rally higher, which will be based on the narrative, a mirage understanding of that the Fed has manufactured a soft landing, which is incorrect. It absolutely is not there. All the signals are in that we have a recession coming. So I'm saying within the next coming 4 months, 5 months maybe, it's going to be what I call a blow off top, because I cannot describe it as anything else and less than that when the markets are going to be rallying as fast as it is.
Henrik, you mentioned something earlier that I want to ask you about, and that is the jobs market, and it's very strong. The economy is growing at around 5%. The jobless rate is around 3.6, 3.7%. There's no indication that the economy is weakening. And then, of course, you have a very strong stock market. And so that's what I want to ask you about, because your thesis is that the market's going to top out in a relatively short period of time, say 6 months. And during that time, it's going to increase 30%. And I'm just wondering, what's the catalyst that's going to take the market lower, and what indicators are we going to see? I mean, if the jobless rate is at 3.7%, that's a very strong economy. What exactly do you see, or what do you anticipate is going to happen that the market's going to correct so fast?
Well, I think first of all that what the market will start to take in the narrative of the soft landing. And that is so misunderstood, because last year everybody was bearish when we actually saw the yield inversion, and you had all these normal indicators that people refer to and say, well, when you have that, you get a recession. And now it seems like people really have forgotten about the yield inversion. But when you actually look at it and you analyze the last many yield inversion, you actually see that from the bottom of the yield inversion, you normally see like 1 year to 1.3 years. I mean, 1 year and 3-4 months from the bottom of the yield inversion to when you see the recession set in. And we had the yield inversion bottom in June of this year, 23 again, 23. I need to stop saying that. But June of 23, we had the yield inversion bottom, which means that actually that would indicate that the recession could set in by June of 24 this year. That's just one indicator. Another thing is that as I said again, the business cycle model that I work with, there is a signal there. There's a recession signal there, which has been back tested 80 years back, and has never made a false recession call, a recession signal. Never called any extra. It's always been correct when done on a quarterly basis, which is what I've been looking at. and that recession signal was in early 23. So and this is just two of them. I mean, I got a whole lot of them. So we got all the signals are there, but people are just being impatient and saying, "Oh, we didn't get the recession, so now the Fed is manufacturing the soft landing. Now it's safe to get back in the water. Let's pour all in because did you see the Nasdaq? Did you see?" and so on and so forth. And people will start to get in there, and that's also why I think you're going to see a lot of the crypto rally is going to be absolutely insane. You're going to see small caps because they have been lacking, and people will start to rotate into that because Nasdaq had taken its fair share of that rally already. So I think that is what will drive the most of it, and also that we now, of course, we now have the Fed pause. At least that's I think that's a given now, and people start to talk about when will we start to see the cut and all that, and they will start to talk that may be a positive thing, which is actually not. When the Fed starts to cut, it's actually a bad thing. But all these things, it's the normal rhythm of the market. It's the normal end of cycle kind of thing, and simply also because so what is the catalyst? I mean, the catalyst is simply everybody was sitting there last year and being oblivion about that we actually had a bull market, and now they want to jump in. Now they see all-time highs starting to be taken out, and then people say, "Oh, I need to see if it takes out all-time high. If it does, well, then I'm in." So I think that's going to drive it, and I think and also Bitcoin. I think also the ETF and all the talk around that will also be a driver of some of the money coming into the market. So I think these are the drivers, and what else is the driver will be that the dollar will decline more. I think we're going to have a very strong decline in the dollar down to like 90 on Dixie, and I think rates are starting to come down strongly also. At the top was in October, it's starting to come down. That is a good thing to begin with. Later down the road, it's actually an indicator of the really bad thing that is going to come. But in the beginning of it, it'll be felt nice and cozy because it's not so expensive to finance your loan, and all these things are starting to be felt. And the same with the dollar. So these things are and with the narrative and with the FOMO will create the blow off top. So yeah, these are the things that will create that, and what will create the recession? Well, that is something that has already been built into the whole setup long time ago. That's a whole lot of other story.
So you mentioned the Dixie, and I want to ask you about that. But before we do that, I want to ask you about the Fed and interest rates. And this whole move that we've seen in the S&P and the Nasdaq in the last couple of months is predicated on the expectation of lower interest rates. And depending on whose research you read, a lot of people are looking for a cut as early as March. What are your thoughts about interest rates? I think the next Fed meeting is coming up on Jan 31st. What do you think the Fed's going to do?
As I say, every time I get on a show like this and people ask me what the Fed is going to do, I say I actually don't care what the Fed does. I care about what the market does, because what the Fed does by the end of the day is that they follow the 2-year market yield. And so I followed what the market does, and sorry for saying it like this, because I really feel that there's too much focus on what the Fed will do, and you can actually just follow the market, the 2-year yields, and then you'll actually understand what the Fed is going to do. And in my world, the market yields, 2-year market yields, are going to get crushed. Not immediately. I think we're going to see strong declines coming in, and there may be bounces on the way, but standing in mid 24. I think the 2-year yield is going to be a lot lower, and they're going to come down really, really quick. And that means that the Fed will start to pay notice of what they see there. So when March, I think will be too early. But what the Fed will do, well, my best guess will be what the market tells me, and that will be that when the rates, the yields, the market yields, 2-year market yields will come down, well, the Fed will then start to follow, and they will have to cut, and they will have to cut a lot, because as I've said on my live show also, the Fed got scared of themselves. They got scared of the genie that they thought got out of the bottle with inflation. I am surprised to see that they actually think that they manufactured the inflation that we got, and has so little understanding that it was the imbalance between the supply and demand, which was the cause of this inflation spike. And now they wanted to get it back in again, and then they're starting to overdo it. So they overdid their rate hikes by, I don't know, many hikes, but a lot. And that is going to haunt them. And if you check some of the, again, leading indicators on inflation levels, on how inflation is going to develop, well, a deflation is already built into that. So you'll have a very, very strong decline in inflation over the coming. Again, nothing goes in a straight line, but I think we will see a very strong decline in inflation coming into later 24, and that means that rates and yields will come down, and the Fed will follow.
So let me just summarize a few of these points. So first of all, you think the S&P is going to move up to the 6,000 level by June, and at that point,
Earlier than that.
Yes, okay. And then at that point, you think the Fed's going to realize, oh my God, we're going to slip into a severe recession. They're going to start cutting rates. They're going to start cutting rates. The US dollar is going to go lower as measured by the DXY index or the Dixie index. And that's also going to create a deflationary environment. So we're going to see all commodities, oil, copper, gold, are going to get hit severely hard. Is that correct?
Yeah, the timing of the Dixie is that I see that the dollar will come down into let's say the same timeline as where we see the stock market tops out. So it's actually the driver of the stock market and the crypto and risk assets in general. Until that timeline, you may see some bounces. I do think that the precious metals are starting to starting its tumble soon here. But because they are more forward-looking in terms of what they see and with inflation and deflation and so on. But you're absolutely right. Yes, by let's say mid-June, by June, we could be in a scenario where the stock market has been rallying very hard. We've seen the dollar coming down. We've seen maybe a bottom in the dollar, and as we start on the next leg up, and I expect a huge rally in the dollar there. I mean, the deflation is always where we also see that. Well. You want to move into something that is a safe haven. You want to move into to the dollar, and so the Dixie, I see that going to around 120. So that rally is going to be very, very tough on commodities and precious metals.
Yeah, but before we see that, the Dixie's going lower, right? It's currently trading around 100, and you see it going down to 90. And so in this deflationary environment, where does the price of gold? Gold's currently trading around $2,000 an ounce. Where do you see it going? What's your target?
Well, I think I've been known for saying 800 for some time, and it's that's still in my range. But I think it's more likely that 1,250 around that area will be reached. And again, because as you know, gold's finest task is actually to supply liquidity at a time where liquidity is hard to be found. And in a deflationary crisis, in a credit crunch, in a liquidity crisis, you need liquidity. And there will be plenty of companies around the world, and countries around the world that will actually be in need of US dollars, and that will be the problem at that point. So that will be felt on gold, silver, and so on. So yeah, it will be very hard on these ends. So 1250 would be my target there, and I have raised it a bit. I say to all the gold bucks that comes after me and say, well, you said it should have been lower much earlier. I said, yeah, but did you actually look at miners? Did you actually look at silver? None of these have actually been above their previous levels. So yeah, gold actually proved me kind of wrong, but it hasn't proved me wrong to the point where I said, well, I have to abandon my thesis, because a strong deflationary crisis will still bring the precious metals down, and I still see that. So yeah, gold did manage to spike up or peak up through the all-time highs, but I don't see that as something you should chase here. I think it's going to go down tremendously, and that's even though if we see another high, I don't think we will, but if we see another high and even 10% higher from the levels we are at now, I still see that it will come down during the deflationary crisis.
No, you raise a very interesting point there, because even though gold was up in 2023, it was up small, I don't know, 5-6%. None of the equities were, right? And many of them, including Newmont, the world's largest gold miner, was down quite significantly on the year. Now, okay, so let's just say gold goes from 2,000 down to 1,200. That's a pullback of about 40%, give or take, which is quite significant. What about the equities? Okay, if we look at the GDX, for example, it's currently trading around $30. Where do you see the GDX going?
I think GDX is going to fall below $10. That's my target here, and I got some more precise targets also, and also for some of the larger corporations. And I am actually, I'm a major gold bug when it comes, to the right point. I just don't want to own gold or gold miners into a deflationary crisis. But I do want to own at the moment we actually see the Fed coming back into the game, and then saying, okay, we now stare deflation right at the eyes again. We need to do something about this, and then that's when I want to get back into gold and silver, but not at this point. And I think that is a little difficult for people to understand, because they have this thesis that when there is a crisis, you need to own gold. Well, yes, because it needs to be your access to liquidity during a crisis. That's what people do not understand. Actually, you want to be in cash. You want to hold US dollars, and I think the US dollar will do tremendously well against all other currencies around the world. So yeah, GDX will drop a lot, and there'll be a fantastic time to buy that when we get to that end of that cycle.
And given the move that we saw in the last couple of years in the actual physical gold, a large part of that is being driven by demand or buying from central banks. What are your thoughts on this? I mean, do you think they are artificially keeping the price up? I guess my question is, if the central banks, if the central bank were to stop buying, right, would the price pull back quite a bit?
I'm not sure that the central banks will be the driver of this move here. And I don't know what their what their ambitions are, and I think they have also strategies that extends wider, and I don't think the central banks of the world are the best traders of the world either. So I mean, there can be many reasons why I don't think the central banks are the ones to follow in terms of why gold should be going up and down. Again, I follow the business cycles, and when you get to a recession, you get to a crisis, where you get to a point where risk asset will be sold off. There are two steps in that. The first part of it, which is the deflationary part, where the economy shrinks, then when the Fed steps back in, well, then there is a good time for it. And central banks and all this, and when they are going to buy it, I don't know too much about that. Maybe there's somebody that knows about that more than I do, but to me, the business cycles and the moment of when the rescue team from the Fed comes in, well, that will probably be my signal to get back into gold.
Okay, so you're looking for a big pullback in gold. Now, what about oil? Because this is also trading around the low 70s. What's your target price for oil during this deflationary pullback?
Well, in 2019, I think we were around this level as well when I said we were going to below $10. I think I have a tweet also on that, and you can go back and take a look at from 2019. And I said we're going to go below $10 in the next crisis. Also, I did not at that point, and I have to say that I did not forecast a pandemic. But what I did forecast, because of the business cycles, because we did see a crossover there again in the leading indicator, was that we were going to see somewhat of a recession, and we did see that. And I said, well, that is going to bring the oil below $10. And I say that again. I think we're going to see oil going below $10 into the hard part of this recession. I think this recession is going to be much more severe than anybody actually anticipated at this point here. And I know that very few can understand, and that a point where we come from high inflation, all of a sudden we should be in a situation again where deflation could be the problem, and oil could go down like that. Well, and also I hear all this, yeah, what about if there's a war breaking out and all these things? I mean, to me, again, the cycles, the structures that I see is what is important, and I don't see events and things like that as drivers of price in general. I see them as, which can, spike things a bit, and then they'll come back down again. But yeah, oil below $10 into the crisis, and it, as I said, that indicates a very, very severe crisis to me.
So in this deflationary environment, how would you position yourself?
Well, right now, let me just be clear on that, because I think people are also struggling a little sometimes about following my timing here, also because it's going to be a kind of a whiplash. I'm long small caps, I'm long crypto, I'm long Bitcoin, I'm long Bitcoin miners. Actually, that's my largest position at this point, and I've been that for quite some time, so that has been good. But I'm waiting for the moment of when I see the top in the stock market. It'll just not be waiting for 6,000. There'll be, I have a whole range of indicators, and if they all come together and I kind of see those getting reached at the moment when we see the business cycle also really turning, and I start to see the deterioration in the labor market, which I expect to happen over the next 3 to 4 months, well, then I will get out of these risk assets positions, and then I'll get long the dollar. I will get long the dollar, versus the euro. I think that we're gonna have a horrific crisis here in Europe for many reasons. We actually did see that we never solved the problems after the financial crisis in Europe. We kind of we really kicked the can here, and it's very evident if you look at many of the stock indices around Europe. So I think I'll be long the dollar there, and I will also probably be short Bitcoin. I know that will not be very popular amongst a lot of my followers also, but I think short Bitcoin will be a very good play into the crisis.
Oh, yeah, I'm glad you brought that up. So we talked about gold, we talked about oil. Bitcoin had a great 2023, up 150, 160%. Where do you see that going in the next few months during this risk-on trade?
It's going absolutely, ballistic. I mean, it's going to go vertical. It's going to go. I think we will reach at least 115,000. That's my minimum target. I think 150,000 is also manageable, and I could also see 250. But my guess here would be 150,000. But would not be surprised to see it's only reached 115. So that is where I'm seeing that. I'm seeing a crypto run like nothing else. I mean, everybody who was not in the first round or in the second round would now say, "Oh, I missed out the 2 first times. I'm gonna be in on this one." And when we start to see Bitcoin moving up above the current levels here, I think that's when we start to, and especially if this ETF announcement comes out or whatever is going to be the trigger of it. Nevertheless, I don't need the trigger in my world. I think the structure tells me that this is what we could see, very, very quick move, and again driven by people. I want to be into this move here now. I was not in NASDAQ last year, and now I need to be in this, or I need to be in small caps. So I think the more riskier assets will be, which I also include cryptos and even Bitcoin, will be having a fantastic first 4 months of the year.
Yeah, that might be me. Okay, if you see me getting into Bitcoin, the end is there.
Yeah.
So you don't paint a very good picture. I got to be honest. Like, so right now in the next, let's just say 6 months, yeah, it's risk on, and we're going to have a massive move. But the gold bugs, especially, they've had a tough few years. Man, it sounds like they're in for an even rougher time.
Yeah. I think that but it's again this about you never marry or never get so close to an asset. It's about understanding why, when do I need to be in it, or why do I need to be in that asset? Why do I need to hide out there? And there are times when the dollar is a good good bet. It's good to be in just having liquidity, and other times where it's good to be having risk assets. And at this point here, and like last year, where people didn't see that this was an inflation spike, and then when inflation comes down, the market will normally bounce up really hard, and it did. Well, people just kind of marry to a position, and I don't really follow that. So I think it's about to me it's about understanding the regime we're in. Right now we're in a Goldilocks zone. We have inflation coming down. We have economy not deteriorating too much yet. So actually we're back to that what we saw also previously, and that is good for risk assets until the moment when the economy has deteriorated enough, and that is starting to show slowly, but it will accelerate over the next coming months here.
No, you raise a very good point. It's not about being a gold bug or being a crypto bro. It's all about making money and limiting your losses, and that's the name of the game right there. You paint a very interesting picture, I must admit, a lot's going to happen in a relatively short period of time, but what could prove your thesis wrong?
Well, if there are 2 ways it could be proven wrong. Either if we don't see the rally, or if we don't see the crash. If we don't see the rally, we should see that the dollar starts to move up really strongly from here. I mean, that would destroy my thesis, because the dollar is so important in actually driving the whole of this. So that would be a problem for me. And that would also be shown in crypto and Bitcoin, because they would not like to see the dollar coming up really strongly, and neither would anything else. So again, the dollar is where I have a lot of attention to, and I think when we reach the Dixie around 100, I think that's really when we're going to see the fireworks in terms of the market rally. So that will be one thing where I'll be wrong. When it comes to the market crash, it is about saying you cannot. I don't think I could be wrong. I mean, yeah, okay. Then people tell me, but AI is coming in, and then it'll rescue the world, and you will not see another recession and all these things, or the Fed has manufactured this soft landing, and they'll stand by us again, and all these things that we normally hear. Well, if the markets keep rallying, and then we will obviously see that. My problem is just that with that thesis, and that's why it's so difficult for me to actually express, is because I see the signals that, I mean, even the Corona crisis were not the Corona, but that we would see a market crash was actually forecasted by this same model. So that you have the crossover of the leading indicators. So I have my recession signal there. I have it on the yield inversion. I have it. We have the top in rates. I mean, we also have to think, why do we see the top in market yields? Why are they starting to come down? That's not because things are good. It's because things are starting to maybe not being so good, and especially if they start to accelerate. So these things actually tell me that something bad is coming down the road. And also the housing market has been, I mean, housing affordability is through the floor here. I mean, it's really, really bad. I just don't think it's like with the Titanic, it takes time for it to sink, and that's what people do not realize, that they are just impatient. So I find it very hard, and I think that is where I'll stand my next toughest stance on FinTwit, is when I now come out and say, especially when the market has reached these extreme highs, and I'll be saying, I think we're going to see a huge market crash. And as I say, I think it's going to be the worst thing we've seen since 1929. It's going to be really, really bad, because the things have been so, we've had these cheap money for such a long time, and we have the whole crypto market where there's a lot of cryptos that is worthless. And even though they will rally, you'll see, these money come out. You have a lot of startups that will have never proven their business value at any point, but they have been kept alive because money has been cheap. You have a lot of S&P businesses that needs cheap money, and so on and so forth. We never solved the debt problem during the financial crisis. What we did was that we poured more money into it. We lowered interest rates and so on and so forth, and we thought, okay, now it's all good again. Well, it's all fine. We can, the Keynesian theory will help us work, so we'll get the growth coming back, and we'll outgrow the debt. Well, guess what? We didn't. So we have all these problems yet, and now they're just coming home to roost, and that's what we will see. So I don't think people really understand that this is what we see 15 years later. Even though they gave Bernanke the Nobel Prize in economics for inventing money printing, I think it's hilarious. I think it really is. It really is, and I hope that somebody will sit down and look at this afterwards and say, "Wow, I mean, we postponed, we kicked the can. Yes, we kicked it 15 years and maybe a little longer, but we never solved anything. And printing money never solved anything. You cannot print wealth. You can only, wealth is something that's created through, the economy and through, labor, hard work from, ordinary people, and innovations and so on, but not by printing money, and that will come, and that will haunt us. So I don't see how we can avoid the crisis. I really, I lack to do so. And if we go through 24, let me put it like this, again, coming back to your question on when will I be proven wrong? If we are in next year this time and we haven't seen the beginning of a crisis, I mean, then I have some explanation to do. And if I'm at mid of 25 and we haven't seen the crisis, well, then I think I'm wrong.
Interesting points. And you make a very good point about the level of speculation, because the speculation we've seen in recent years is like
Exactly.
Nothing we've ever seen before. I mean, you mentioned cryptocurrencies, right? There's hundreds or thousands of cryptocurrencies worth trillions of dollars. And then of course NFTs, everybody's forgotten about NFTs and SPACs. Like, oh my God, it's just one asset class after another.
Yeah, absolutely. But you always see that. You see that around new technologies come out, and I like to talk to friends around this, and I say, well, when you had the railway coming out, you had a lot of speculation around that time because a lot of ideas on what the railway could be used for in 1830s, 40s could be used for, and you had a lot of companies coming up, and they spiked in terms of price. But they never, then they collapsed again. They never, lived up to that. And you had it again, of course, with, in newer times with the .com and everything like that. We know how many of these companies never, became of anything. So I think we are now in a situation here again where we see a new technology coming out. Blockchain is the technology, and we see, a lot of it with AI, machine learning, robotics. We see all these this new world that will be shaping us for the next coming many years. It's the industrial revolution 4.0, and that will drive growth for the next many years, but it's not what's going to save us for the next 6 months or 12 months or 18 months. That has already been built in what we've done earlier on. And as I said, there are so many the speculation around this technology here is just because it's so easy to accessible, and it's a way you can be part of it. You just need to open a wallet or whatever and get on an exchange, in a crypto exchange, and then you'll be buying into it. I think we'll see a lot of ordinary people lose a lot of money, and I if we look at the subprime prices and just say what kind of if the crypto market actually collapses, which I could fear it could do, when it reaches the top, which I see it's around maybe 4.5 trillion, well, that's a lot of money that are being pulled away from people where they maybe been forbid that they do, but may even have been loaning or getting loans to buy into this market. Well, then you're going to see a lot of havoc coming out of that. I think that is what we can see.
Well, that was a fascinating discussion, Henrik. As we wrap up, if someone would like to learn more about you and your services, where can they go?
Well, we have the Zeberg report where I, on a weekly basis, sit down and I explain what I see based on my understanding of the of macroeconomics, my business cycle model, and my and the technical analysis that I do. And also, I've also come up with a recession watch indicator now that I'm following really closely, and I think I'm going to be very close to actually calling the recession either in the month or on the at least not more than 2 months away from actually the beginning of it. So this we do on the zebergreport.com, and you'll hear me talk every week there.
And you're also very active on Twitter. What's your Twitter handle?
That's at Henrik Zeberg, and I'm active there also. Try to put out some of the thesis or the perspectives that I have on the economy and the markets.
Well, once again, I want to thank you very much, and I look forward to our next discussion.
Thank you very much for having me on, James.